Hi Matrix, welcome to the Durban Online Academy channel. In this video, we'll be looking at the exciting topic of inventory valuation. We'll be going through a question from the February-March 2018 National Senior Certificate exam. In 2.2 Mongi Traders, it states that you are provided with information relating to Mongi Traders. The business sells one type of plastic table. Their financial year ends on 31 December. The business uses the FIFO method to value their stock. They use the periodic inventory system. In 2.2.1, we are required to calculate the value of the closing stock according to the FIFO method on 31 December 2017. So that's the end of the financial year. When we calculate the value of the closing stock according to the FIFO method, we use the cost price per unit of the stock which was purchased last by the company. In other words, we assume that our closing stock units come from the stock that was purchased last by the company. So you can say that the formula for valuing closing stock is closing stock units multiplied by the cost price per unit. What is the cost price per unit? The cost price per unit is the total cost of each unit. It consists of the purchase price paid to the supplier for each unit of stock as it appears on the supplier invoice, the carriage costs of bringing each unit of stock to the place where it will be sold, any customs or import duties that were imposed by SARS for each unit of stock imported from another country. When we add all that up, we get the cost price per unit. So let's do the calculation. In information A under inventories, we are told that on 31 December 2017, we had 440 units of stock on hand. So that's our closing stock units. Remember, we said that under the FIFO method, we assume that our closing stock units come from the stock that was purchased last. So let's look at the stock that was purchased by the company during the year to see which stock was purchased last. In information B, under purchases, we can see that the company bought stock 4 times during the year. The last purchase was on 30 November 2017. There were 300 units purchased on that date, but we have 440 units of closing stock which we need to be valued. So these 300 units are not going to be enough for us to do the stock valuation. So it means that we must now assume that the rest of the closing stock units which were purchased come from the second last purchase. So that is the purchase that was done on the 30th of September 2017. That means that we are going to assume that 300 of the 440 units of closing stock were purchased on 30 November 2017. And we are going to assume that the remaining 140 units of closing stock come from the stock that was purchased on 30 September 2017. Now that we've allocated our closing stock units to the last purchases, let's determine the cost price per unit for each date. For the 300 units of closing stock, which we assumed was purchased on 30 November, the cost price per unit is going to be the purchase price per unit of 400 Rand plus the cost of carriage per unit of 30 rands. In this question, there is no customs duty, so we don't have to concern ourselves about that. That means our cost price per unit is going to be 430 rands. For the 140 units of closing stock which we assumed was purchased on 30 September, the cost price per unit is going to be the purchase price per unit of 350 rands plus the cost of carriage per unit of 25 rands. That means our cost price per unit is going to be 375 rands. Now that we have our cost price per unit, we can calculate the value of closing stock using the FIFO method as: for the closing stock units assumed to be purchased on 30 November 2017, it's going to be 300 units multiplied by 430 rands. This gives us 129,000 rands. For the closing stock units which were assumed was purchased on 30 September 2017, the calculation is 140 units multiplied by 375 rands. And this gives us 52,500 rands. So when we add the two amounts together, we get 181,500 rands. So that is the value of our closing stock when we use the FIFO method. In 2.2.2, it says that calculate the following for the year ended 31 December 2017. Cost of sales and gross profit. So let's look at cost of sales first. The formula for calculating cost of sales is cost of sales in rands is equal to opening stock in rands plus purchases in rands plus carriage on purchases in rands plus duties in rands minus returns in rands minus closing stock in rands. The value of opening stock is given to us as 189,000 rands. Purchases is given to us as 840,500 rands. The cost of carriage on purchases is given to us as 58,100 rands. The value of returns is given to us as 19,000 rands. The value of closing stock we've already calculated above to be 181,500 rands. Therefore, when we do the calculation, we end up with cost of sales figure of 887,100 rands. Now that we have our cost of sales figure, we can calculate the gross profit. Gross profit is equal to net sales minus cost of sales. In turn, this is equal to sales minus debtors allowances minus cost of sales. Our sales figure is given as 1,380,000 rands. There's no debtors allowances in this question, so that is 0. Our cost of sales, as per our calculation above, is 887,100 rands. Therefore, when we calculate, we get a gross profit figure of 492,900 rands. In 2.2.3, it states that the owner considers changing the stock valuation method to the weighted average method. In other words, the owner wants to change the way we value our closing stock from the FIFO method to the weighted average method. In the first part of the question, we are required to calculate the value of the closing stock on 31 December 2017 using the weighted average method. When we calculate the value of the closing stock according to the weighted average method, we value each unit of closing stock at the weighted average cost price per unit. So the formula is value of closing stock is equal to closing stock units multiplied by weighted average cost price per unit. Our closing stock units are still the same, 440 units that were given in the question, so that hasn't changed. The weighted average cost per unit is calculated as follows. Weighted average cost per unit is equal to total cost of units available for sale divided by total number of units available for sale. Let's start with the total cost of units available for sale. This figure is calculated as follows. Total cost of units available for sale is equal to opening stock in rands plus purchases in rands plus carriage on purchases in rands plus duties in rands minus returns in rands. Our opening stock in rands is 189,000 rands. Our purchases in rands are 840,500 rands. Our carriage on purchases in rands is 58,100 rands. There are no duties in this question, so that's going to be 0. And our returns in rands are 19,000 rands. So when you calculate this equation, you get the number 1,068,600 rands. So that's the total cost of units available for sale. 1,068,600 rands. For the total number of units available for sale, we calculate them as follows. Opening stock units plus purchased units minus returned units. Our opening stock units is 540 units. Our purchased units is 2,250 units. Our units returned is 50 units. This gives us a figure of 2,740 units as the total number of units available for sale. So now we can calculate our weighted average cost per unit as 1,068,600 rands divided by 2,740 units. This gives us a weighted average cost per unit of 390 rands. So the value of closing stock under the weighted average method is going to be 440 units of closing stock multiplied by 390 rands, which is the cost per unit under the weighted average method, and this gives us 171,600 rands. In the second part of question 2.2.2, we are required to determine what will be the effect on the gross profit if the owner changes the valuation method. We are also required to provide figures. For us to determine the effect on gross profit if the owner changes the valuation method, we have to compare the gross profit under the FIFO method versus the gross profit under the weighted average method. Since we already have the gross profit under the FIFO method, let's calculate the gross profit under the weighted average method. Gross profit is equal to net sales minus cost of sales. This equals to sales minus debtors allowances minus cost of sales. Our sales is given as 1,380,000 rands. There's no debtors allowances in this question, so that will be 0. Our cost of sales is calculated as follows. Cost of sales is equal to opening stock in rands plus purchases in rands plus carriage on purchases in rands plus duties in rands minus returns in rands minus closing stock in rands. The value of opening stock is 189,000 rands. Our purchases are given as 840,500 rands. The cost of carriage on purchases is 58,100 rands. There are no duties in this question. The value of returns is given as 19,000 rands. The value of closing stock using the weighted average method we have calculated to be 171,600 rands. So when we calculate this equation, we get cost of sales figure of 897,000 rands. So that means that our gross profit is equal to 1,380,000 rands minus 0 minus 897,000 rands. This gives us a gross profit figure of 483,000 rands. So the difference between the two gross profits is going to be 492,900 rands under the FIFO method minus 483,000 rands under the weighted average method. And that gives us a difference of 9,900 rands. So if the company changes the valuation method from the FIFO method to the weighted average method, gross profit is going to decrease by 9,900 rands.